Hey guys, Buddy from Bali here at Fox with Stocks. Jay writes, "Hi, I am new to this. I think I understand how this strategy will work in a steady market. I'm curious how the options make more money in a upward market. For example, many of the long-term stocks in good ETFs shot up higher than anyone could predict last year. If I had covered calls in them, I probably would have lost those shares ETFs, and buying back the covered calls would have been expensive." So there's mistake number one. So what is the strategy in a bull market? Same in a flat market. Where can I learn more to understand how this strategy works better than holding the stocks during the bull market? So thank you. You can come to our channel and learn more about it, but I'm going to answer a few questions in here, and if you guys have been following the channel, hopefully you can see the disconnect. So number one, it doesn't matter if it's a bull market or a flat market. This is a bull strategy, so the question is kind of backwards. You should be worried about what happens during a bear market, not what happens during a bull market. But the problem here is he thinks that number one, you start with a covered call. This is the wheel strategy, not the covered call strategy. Sorry to be facetious or condescending in any way, but for some reason I can't figure out. People read about this strategy, or I explain the strategy to them, and then they skip past the covered short put completely, and they just go straight to selling covered calls. That is not the wheel strategy, okay? Just because you're selling an option doesn't mean you're doing the wheel strategy. And it's just one of those things. It irks me a little bit, but I wish there was some way that I could fully convey it without having any misconceptions. Just because you're selling a put or selling a call doesn't mean you're doing the wheel strategy. So let's talk about, well then, what is the wheel strategy? You start by selling a cash secured put in the hopes of not being assigned and collecting premium. If you get assigned, then you sell a covered call, and you don't care if it gets called away. You either collect premium only, or you collect premium and it gets called away. You're not worried, quote unquote, that it's going to get called away. That's not the wheel strategy. If you're worried that it's going to get called away, you're just trying to soak up more premium on stocks that you wish you owned. Nothing wrong with that. I do that too. Okay? But that's technically not the wheel strategy. Now, there's many variations to the wheel strategy, but let's set our goal here, right? Our goal is to find a stock that is a good growth stock that we like. We're going to sell a cash secured put so that we're going to make premium. And if it goes down past our strike price, we're not going to buy back the put and hope to get out of the situation. That's not what we're doing. That's not what the wheel is about. The wheel is this safe, comfortable strategy where we sell. Say, for example, it's trading at $25. We might sell the $22 strike, and if it goes down to 21, we don't buy back the put. You follow me? We just take shares at $22 a piece. Then we hope to sell a covered call at $23, $24, $25 a piece. Worst case scenario, at 21 plus a dollar, you're at 22, you break even. That's actually not the worst case scenario, but that's the worst part of our plan, because then you're not really making too much money. I feel like I'm going off track now, but do you guys get it? Please let me know in the comments below if you guys are getting this. Okay, you're selling the $25 strike at 22 because you want enough distance that you don't actually get assigned. If you just want the shares, just go buy the shares, but don't go around calling it the wheel strategy, okay? So you're selling a put, hoping to collect the premium, and you don't mind if you get the shares. So it's at 25, you want to be selling 22, 21, 20, somewhere in there to get a nice premium, 2, 3, 4, 5% every 30 days, okay? And then you're hoping that you don't get assigned, and then you just keep the premium. If you're not doing that, it's probably not the wheel strategy, or it's some variation of the strategy. Now, if you could you can mix and match this, okay? Let's say it's a stock that you really want. You could actually sell the 25 put, the 23 put, the 22 put, the 20 put. You can sell a whole bunch of puts in there if you want to, and then maybe you get assigned on the 25. Well, you still get to keep that premium. And then you don't get assigned on the 22, 21, and 20, so you get all that premium. And now you just have a nice low cost basis for the shares that you did get assigned at the 25. Okay, that's some variations to the wheel strategy. But this is where our friend Jay is a little bit confused. You don't go out, buy 100 shares, and then sell the covered call, and then buy it back if it goes up. That's not the wheel strategy at all. Please don't do that. Okay, what else did he say in here? And then again, it's a bull market strategy, okay? When we sell the put, we want the stock to go up. We want it to go up because we don't want it to hit our strike, okay? And I said we don't mind because we don't care. We picked a good company. If you pick a good company, you don't mind getting assigned the shares. But in an ideal scenario, I'm going to sell a put, trading at 25. Next day, again, ideal scenario, boom. Next day, jumps up to 30. Now my $22 put used to be $3 out of the money. Now it's $8 out of the money. So what am I going to do? I'm going to buy it to close early for a profit. For a profit, not for a loss. Okay? So we're not starting with a covered call, and we're not buying back at a loss. We're starting with a put, and we're buying back for profit. We're getting faster profit. You're not going to make quote-unquote more profit, because if you got $1 in premium, you're not going to buy it back for negative. You're not going to get more credit when you buy it back, okay? You're going to buy it back for 10 cents, 5 cents, 45 cents, 50 cents, okay? You're going to buy it back for less than what you sold it for, which is how you're going to lock in a profit. So you're not making more, right? If you just waited for it to expire, you'd get the whole dollar. But you're going to buy it back because if you can get 50 cents in one day, you can take that $50, apply it to your account. That's $50 times the number of contracts, okay? You can do any number of contracts you want, or whatever your account size can handle, okay? You can take that and roll it into a different trade. So as long as you do that, if you roll it into a similar trade, you're going to double your APR by closing early 50% in the first week. You're going to double your APR. It's amazing. That's how you can make more than 50% a year, because you're picking stocks that have 2, 3, 4, 5% a month. That's going to compound to 24 to 50%, but you're also going to close early and roll forward. I'm sorry, you're just going to close early. I'm not going to say roll. Roll is the wrong term in options. Okay, you're going to close, and then you're going to take that money and you're going to put it into another trade. Okay, and this doubles your APR, and this is how you stack and rack much faster. Anyway, so I hope that clarified that. And again, last thing I want to say, this is a bull strategy, so you shouldn't be worried about what happens during a bull market. You're off kilter. This is a bull strategy. You should be worried about what happens during a bear market. And the answer is, we don't keep wheeling every single day if we think it's going to be a bear market. Now, if we hit a dip, it's okay. We get assigned our shares, we sell some calls, we watch it go back up again, it recovers, that's fine. But if you're in a market like the Chinese market, okay, where people don't trust the stock market, they have inflation, but it's not really helping the stock market. They have too many people retiring, not enough people entering the workforce. They have all these issues, right? And so the Chinese stock market is slowly going down over time. I would not use the wheel strategy there. Would not use the wheel strategy there, okay? But if you're in a market that's slowly trending up, even if it's from quantitative easing, whatever the case, okay? As long as it's trending up or sideways, this is a good strategy. Anyway, I hope this helps. Hope that answers all these questions. And I know it seemed like such a simple question, but it's so misaligned that we had to talk about multiple things during this.